Welcome to the Quarterly Market Update. Today, we're going to be digging into some of the main things that we're spotting when we're looking across markets and economies. We're going to dig into some of the stimulus measures the Chinese government are taking to try and reinvigorate the Chinese economy. We're going to consider the fine balancing act that central banks are having to undertake in getting interest rates and inflation right. And we're also going to have a think about what's going on with the US presidential election as we get into the last weeks of the campaign. So today I'm joined by Roxanne and Hugo. Welcome.
Thanks for having us on.
Thank you.
Hugo, I know we've been talking a lot about this, but the last quarter was a bit interesting. How did markets play out?
There was a lot of volatility in the middle of the quarter, but if you look at the returns over the entire quarter, they were really strong. We pretty much had every asset class firmly in the green. It was really pleasing to see in September as well. We saw a bit of a rotation. Some of those unloved pockets of the market, like small caps, value stocks, real estate, do quite well. And that was really on the back of the Fed, the Federal Reserve, opting for that 50 basis point cut in September. And they just joined the party of the global rate cutting cycle. Obviously, our own RBA is holding out and looking likely that they probably won't cut rates until early next year, but it was a really positive quarter for markets.
And the Chinese government started getting a little bit more active with stimulus?
Certainly. In the last couple of weeks, we saw the Chinese government come out with a range of stimulus measures. So there was the interest rate cuts, which they've done quite a few times throughout the year, but they did that again, alongside a facility that helps support the stock market and encourages investors to invest in the Chinese stock market, as well as the promise of, I guess, a vague fiscal stimulus policy to come down sometime in the future. The Chinese economy has had a rough, 2-3 years, partly because households, corporates have taken on way too much debt, and they've also got a deflating property market at the moment. It's not a great recipe for the Chinese economy at the moment. So these range of stimulus measures aim to help support the economy, targeting infrastructure spending back up, targets key industries, and also tries to help boost the consumer confidence and domestic consumption as well. They're dealing with a lot of problems at the moment, which are quite large, and so the fiscal policy needs to be equally as large. So far, we haven't really seen that huge fiscal policy come through, but the market certainly is hoping that'll come through, particularly when we saw the Chinese market jump 20% in the last week or so of the quarter.
Yeah, they certainly do need to get it more forceful, particularly when you consider that working age population is expected to decline by about 40% over the next 30 or so years. They do need to get up ahead of it. And I noted this morning that the announcements around the fiscal policies were a little bit vague, and markets have drifted back off the back of that. Now, another thing that's sort of getting the mind going is what's going on in the Middle East. Obviously, it's pretty horrible what's going on over there. We've got the highest degree of conflict in probably about 50 years. Roxy, how do we think about that?
Yeah, look, we're obviously watching the situation really closely, but I must say that normally or typically geopolitical issues don't have too much long-term impact on markets. We may see an uptick in oil prices over the short term, but there's no expectation that that'll feed into a long-term situation. The US is now a huge producer of oil, in fact provides most of the oil supply globally, and Iran is unlikely, in our view, to start interfering in matters, although historically they've been a big supplier of the oil globally. That's no longer the case. So whilst we're watching Iran, we're not overly concerned with the situation. Certainly Israel is signalling that they are not to be messed with. And again, just something to watch and be very cognizant of. The Strait of Hormuz is where 20% of the world's oil is channeled through that strait. So we do need to be mindful that there are considerations. But look, as I say, not expecting any significant long-term impacts in terms of what's going on in the Middle East right at the moment.
Yeah, oil could definitely feed into the inflation problem that we have.
Well, that's absolutely right.
Yeah, it's quite encouraging though. Saudi Arabia looks like they're boosting oil production at the moment, and Libya also looks like they'll turn on the taps once again. So that'll help, keep oil prices under control. Andrew, we do talk about geopolitical issues that are going on, but central bank policy has dominated for the last 3 years. Where are we at the moment, and how are central banks thinking about those long and variable lags that they have to deal with?
Yeah, I mean, look, I don't envy them. There's a lot of smart people working at central banks, but those long and variable lags are tricky to deal with, and you don't get a lot of sort of test economies so you can figure things out. There's only one economy that you can tinker with, and it's yours, right? It's really important that you get that right. And we like to think quite often about the long and variable lags that they have to deal with. And I think one of the best analogies that I've ever come across is Milton Friedman, who's a very famous economist, talking about it as a fool in the shower. And if you think of if you've ever been in a house with old plumbing, it's that idea of you turn the hot water up just to get it hot, and before you know it, you've already passed it and you're being burnt. And so you're quickly turning the hot water down and the cold water up, and all of a sudden you're freezing again. And it's that's sort of the kind of conundrum that central bankers have to deal with, that they're trying to solve inflation. We know inflation, once it gets embedded, hurts everyone in the economy, most acutely those who can least afford it. But we also know that if you put too much effort into killing inflation, you can create lots of unemployment. And so what we saw, Federal Reserve in the US, case in point, that they saw a revision to unemployment numbers, which gave them a belief that the employment market in the US was softening, which is partly what fed into them doing a 50 basis point cut at the end of September. However, as we've seen since then, there's been some labour figures come out that look all the more positive. And so here they are sort of, turning up the cold and turning down the hot and trying to find that balance. And so, what we have to realise in their case is some things that they're having to try and contemplate haven't played out yet. There are market dynamics, there are economic dynamics that they can't see the future. They almost need to see the signs of what's happening. But the good news is, we do feel that we are getting closer to that stable point. And of course, Roxy, when we think about income production of portfolios, that's quite important for some of our clients.
Well, that's right. What we're experiencing at the moment is a decreasing interest rate environment. Now, obviously, our clients will often talk to us, well, how does that impact on income producing assets that they hold in their portfolios? And really our view is that yes, whilst interest rates are pulling back at the moment, they're certainly not going back to a 1%, 2% type of scenario. Interest rates still remain higher than they have done at any point in the last 10 plus years. And we would certainly expect as we return to a more normalised interest rate environment, we'll see less volatility in the equity markets, and therefore we would expect that income producing assets will play their role more appropriately in portfolios. So that defensive part of the portfolio that delivers good, strong yield in addition to the capital growth that you would expect to get through the equity portion of a portfolio. So on balance, we're very comfortable where interest rates are heading and the impact on income producing assets as they sit as part of an overall portfolio position.
Yeah, it's really important. I mean, I remember going into the Great Lockdown, the pandemic. Most of the income being generated within portfolios came from Australian shares, and most of the income coming from Australian shares came from Australian banks. And of course, as you remember, going into the pandemic, APRA told Australian banks they weren't allowed to pay dividends, and so all those clients that were looking for income to come from portfolios suffered as a result. So now it's nice that the heavy lifting of income generation is more evenly shared across the portfolio. Coming into the US presidential election, that's definitely going to get louder. It's going to take up more of our news flow moving forward. Hugo, you've dug into this for our special report. What did you find?
Sure thing, yeah, it's definitely going to get louder. November 5th is just around the corner, and it's looking like a pretty dead horse race at the moment, with neither candidate really pulling ahead. The polls are slightly favouring Harris at the moment, but it's within the margin of error, and we know Trump supporters are underrepresented in those polls. So I'm not going to sit here and pretend like I know more than the pollsters. But what we do know, looking at the last 70 years of elections, that coming into an election, it certainly is a volatile period. We do normally see a bit of a sell-off, and that's partly because there's uncertainty in the market. There's uncertainty around who will be sitting in the White House and what does the future look like, depending on the policies they'll enact. However, the good news is post an election, returns are normally pretty good, as long as we don't see a recession. So the message to investors, I think, is to stay the course, don't make any knee-jerk reactions, and hopefully once we're past November 5th, markets will once again focus on the underlying fundamentals rather than who's sitting in the White House.
Thanks, Hugo. And thank you, Roxanne. I've enjoyed the chat. Hopefully you enjoyed that too. The report does go into more detail of everything we've talked about today, and we look forward to seeing you next quarter.